Yeah, I mean, look, I not interested in new longs right now at all. Uh, and if it goes higher, it goes higher. I'm fine with that. I zero FOMO. And if people want to go wild and reckless, go right ahead, have at it. To want to chase something in the current backdrop, basically tells me, from my perspective, I have to abandon all discipline and process. There's no precedence for the valuations we've seen, right? I mean, this market could drop 50% and we would still be richly valued vis-a-vis all of history, right?
Mhm.
And maybe surprisingly, we do get a recession, and all these things actually do matter into next year. But I'm not shorting this. I'm not interested in shorting any of this.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When Sven Henrich of NorthmanTrader.com was last on this program in May, he stated that it was do or die time for the bears. Well, they died. Since May, the S&P has rocketed to new all-time highs. We now see many equity valuation levels at their most extended heights in all of history. Though this is happening at a time when the global economy is showing increasing signs of slowdown. So, as we head into the end of the year, can the bulls maintain their dominance? Well, to find out, we'll now hear from the man himself. Sven, thanks so much for joining us today.
Hey, Adam, good to be with you. I was, by the way, in the summer, I was desperately waiting for you to show up, and
Ah,
it never happened.
I deserve this. I deserve this. But I got to say, nobody was more disappointed than I, Sven. So yes, folks may remember I headed over to Ireland to meet my daughter there for a bit, and the plan was then to hop over to the UK to go chop some wood with Sven, and I had to amend the plan right at the end and come home early to the US. So I left Sven in the lurch. But dude, I will definitely get over there. That's a rain check, not a cancellation.
Well, now that you told me that you had COVID right after, I'm glad you didn't show up. Nothing personal, but
Yeah, I mean, you're glad I didn't show up, really, in retrospect. Yeah. You might have been stuck with me for a couple of weeks there.
exactly.
All right. Well, look, Sven, we'll get into today's discussion in just a second. I want to thank you, A, for coming on today, but also thank you for being a faculty member at the upcoming Thoughtful Money Fall Online Conference. And you're going to be creating one of your excellent chart deep dives for that conference, giving us your latest on where you think everything is happening market-wise then. Today, we're going to be at a little bit higher level. I'm sure you got some charts you might want to pull up. If you do, please feel free to do that. But I wanted to let folks know that if you appreciate Sven Henrich's TA and his charting prowess, you're going to get that in spades at the conference. And so if you want to register for the conference, just go to thoughtfulmoney.com/conference. You can buy your ticket there. You can still buy it at that lowest early bird price discount as well. And a reminder, the conference is going to be on Saturday, October 18th. And don't worry if you can't watch live, because replay videos of the whole event, including Sven's wonderful chart presentation, will be sent to everybody who registers. With that out of the way, though, Sven, as I said in the intro here, really interesting time because, as you said, it was do or die time for the bears. They rolled over, and the bulls have been walking over them ever since. And so I think we're at a point where the market has really gotten that hubris again, that like it's just going to be eternal summer. It's just going to be an eternal bull market from here. Um, doesn't mean that it might not be for the next 6 months, year, whatever. What are you taking from this? Because I know that in your heart, you have some skepticism at these high valuation levels, but I know in your mind you say it doesn't matter until the market starts pricing that in.
Well, we make new market highs every single day. There's no more downside whatsoever. Stocks are risk-free, and we will go up forever. Thank you for joining today's podcast. Have a nice
Oh,
day.
we're done. Okay, thanks. Great.
No, I mean I have a few thoughts on all this, and maybe I'll share just a couple of charts to start with. But the concept of new all-time highs here in the fifth year of the cycle is not a surprise. I mean, you and I have talked about this
Yes.
a few times, actually going back all the way to January of 24 when I put out this Cynic's Guide to Market, and I put out this chart that just says the fifth year of this 10-year cycle just kicks in. I mean, it's actually quite amazing how simplistic everything is on this basis, right? I mean,
It's spooky, and not just
it is
simplistic,
spooky.
kind of spooky. Yeah.
We've had troubles in the latter part of the decade, and we had troubles in the early parts of the decades, right? I mean, we all remember 2008, 2009. Not to say this is all perfectly lined up, but we just had a major low in 2022, right? We had a low in 2003, right after the recession. So there's definitely some history. It goes all the way back to 1897, and for some reason that I don't know, but it just happens. In that article back then, I outlined all kinds of fifth-year examples that just went up. And it hasn't really changed on that basis, right? And so here we are, going back from the 2009 lows, and this
Yep.
to me is kind of the eye opener in general and everything
All
since.
right. And so, sorry, so I'm really sorry to interject, but going back to the previous chart just for a second,
Yeah,
it's a recurring 10-year cycle on the Dow
yeah,
Jones, but it's a cycle that starts at the 0 year, correct?
yes. So at the beginning of each decade, and then where we are now is the fifth year of that cycle, which is
Right. So
traditionally the most bullish.
2015, 2025, 2035, that would be year five in this cycle chart.
Exactly. And in fact,
Okay.
2015 was kind of a little bit of an exception. We did make new highs, but it was all kind of a little shaky in the latter part. And I'll get to that in a bit because if you're specifically asking about the end of the year run, which is basically standard fare, but of course now we're in the situation where we have the most highest valuations ever and quite some amazing chart stretches that make you scratch your head a little bit. Hence, I think it's really important to understand what is driving all this, where it makes sense, why it's happening, and are there any type of signals that suggest there may be some risk actually building? And
Mhm.
absolutely clear at this point, so far, nothing has mattered. Okay, absolutely nothing. Not certainly not valuations, which are at record levels. In fact, we just kind of keep running the same program we've been running since 2009. This is a quarterly chart of the S&P. It's actually quite stunning in terms of the one-way message of markets. Quarterly charts, basically what it shows you is that red candles are so exceedingly rare. And you
Mm.
have these big mega rallies that go on and on and on. And once in a while, even a down quarter is not even a disaster. It's just basically reconnects with the quarterly 5 EMA and holds support. Since 2009, just ponder this, we only had three events where there was more than one quarterly red candles. This was here 2011 when they were forced into the next QE program. We had then here 2015, 2016. Remember, this was when we had the kind of quick earnings recession, but there wasn't really any major damage done here.
Mhm.
COVID is mere blip because obviously then we went into massive printing. And then the 22 tightening cycle. I mean, that was the most extensive down move we had in terms of time, three quarterly red candles. Well, now we're back to program here, and every quarterly 5 EMA tag is basically support. Obviously, we had that blip here in April that was averted. Now, if you look at all of these guys, quarterly 5 EMA are common, but sometimes we have, like here during this peak printing time, 2020, we just don't even have reconnects of that.
Right.
But they happen quite regularly in generally speaking. Okay. Now, in terms of year end, if you look at all of these years, the only time there was some sort of trouble in terms of year end was basically here in 2015, which by the way was also fifth year of the cycle, but it did make new highs. And then 2018, right? That was the time when the Fed was forced to flip-flop, right? They
The
were
Powell pivot. Yep.
the Powell pivot. Other than that, it's been basically, if you get a quarterly 5 EMA tag in the September timeframe, it usually tends to hold a support. We're not even close to it yet, when we may not tag it. But if we were to tag it, I'll call it roughly a 7-8% correction, and then it probably sets up as a buy unless something completely structurally changes in the current setup. Now, if I look at all this from a valuation perspective, of course, I can cringe on all this because
Right.
we are so far extended, and I can talk about this a bit more later. But I just want to also accentuate how, since you and I talked there in May about do or die time for bears, because based on that 50-year cycle, you could already smell all this coming. I want to highlight here a weekly chart just to show how one way this market has been. Like with the quarterly red candle chart here on the weekly chart, you can see how we barely had any red candles whatsoever. In fact, here
Hmm.
the last 13 weeks, we only had one little red candle, right? And I can't even call these previous 3 weeks down weeks because they didn't even touch the weekly 5 EMA. It was not even, what downside? It's just chopping in range and pausing at the most, if you will. The one time we had a close below the weekly 5 EMA was actually just driven by one day. It's actually hilarious. And I'm mentioning all this to understand the control mechanics of how this market has been running. And in fact, that that move down, that closed below the weekly 5 EMA, it was just a one down day. And then just gapped right back up, and we've been on the same program. And this is a daily chart. And the wild thing I noticed, I don't know if you guys have noticed this, but if you look at that in the last 4 months, when was the low of the month made? You're not going to believe it. First trading day each month. June, the low is in. July, the low was in for the month.
Mm.
August, the low was in. And here we are in September. We're basically repeating the same program. I mean, that's just how straight and up, obviously, 45-degree angle, if you will, that we're going up here. It's quite something to watch all this. And of course, and this is why, despite all the valuation concerns, I want to highlight as to what is driving all this. And it's so important to understand. First of all, this is a chart overlays S&P 500 with junk, high yield bond ETF. They're joined at the hip. And to me, it's one of the measures of financial conditions, easing of financial conditions. The low was in right here, October 2022. That's when we had peak tightening. As you may recall, this was the infamous Yellen concern pivot. When things were just about to break down structurally from a technical perspective. And the entire rally since then, with the occasional correction, has been driven by ever easing financial conditions to the point, and this is a weekly chart, we now have a flatlined 98% weekly correlation between the two. It's just dominating everything, easing of financial conditions. It's pretty wild, especially now in context that, here we are with markets at record valuations, asset classes everywhere flying through. And now the Fed wants to ease financial conditions even further with another rate cut, right? I mean, the notion is that the Fed has been running some sort of restrictive monetary policy as they still try to cling on claiming with in regards to rates. Yeah, maybe in terms of rates, but in terms of what's actually happening in the market, that's just a big Fed lie, right? And so it's kind of stunning to see that we are now presented with this setup because basically it screams higher and higher. That's what everybody's counting on, right? The other driver, besides aggressive easing financial conditions, of course, the RRP facility, which is kind of linked to that because this was our, again, here in 22, this peak. And this facility has been drained to now a smidgen, right? So basically, when the facility drains, when you have the occasional spikes here that introduce some volatility in markets because it takes liquidity out. Usually we see this either at quarter end or month end, but last month end there wasn't really anything there. But the major message is this is $2.5 trillion almost of liquidity that got pushed into these markets. Oh, since 22. No wonder we're seeing this continued melt up in asset prices. So liquidity is massive. and or has been massive. But you can also argue, well, this well is run dry. What does that mean? Is there maybe a leg of the liquidity that's going to be missing going forward? Is that a risk to market? Question mark.
Right. And sorry to interrupt, but it might
Yeah.
not be just a missing leg. I kind of tell people to think of the reverse repo program like a sponge,
Yeah.
which is when it's saturated, you can squeeze it, and that provides liquidity, right? That the money is flowing out of the sponge into the system. But if you decide you want to refill it, it acts like a dry sponge, where it sucks liquidity out of the system. So if they decide to start refilling the RRP, it won't just be a missing leg. It'll actually be something that is tightening the system.
Yes. But obviously they're if they're now concerned about the labor market, they don't want to talk about tightening. What's actually interesting to me, if you think about it, if the labor market is really weakening, based on the data that is available, you have to kind of wonder how that's possible structurally, considering how much liquidity has been flowing into the system. With this much liquidity and easing financial conditions, why are there trouble? Why is there supposed trouble in the labor market,
In the labor
right?
market, right?
Um,
Um,
and and I guess I've been bemoaning the interventions obviously for years, and we all have been subject to massive asset price distortions as a result of that. And you know, to many eyes, I guess you can argue that the regular natural business cycle has long been stunted because we always intervene at the first sign of trouble in ever greater amounts.
right.
Is there still a natural business cycle out there that may be sending a warning signal? But I don't have the evidence of that yet. And of course, besides the easing financial condition, overnight repo, buybacks. The money keeps getting flooded with buybacks. It's actually stunning here in 2025. JP Morgan has a potential 38% increase over last year. We had already record buybacks. And obviously, what this all does, buybacks are reducing the available shares in the market, right? Because it reduces the float. And it's also a clever mechanism to show nice earnings growth on a per share basis, right? I mean, there's
Right.
just massive money flooding through the system. And so, yeah, you know, that is keeping a bit under the market, as JP Morgan also points out.
And that's a
And
38% year-over-year increase in all the buybacks.
yes,
Yeah,
for
that's
up to
amazing.
1.9 trillion dollars in 2025 alone. That's kind of the potential that they see for this year, and they're saying they're already at a 1.5 trillion for this year. So this just goes to show how much money is flowing in, and of course, we have all, and we can talk about that separately. But this whole machine of passive investing, right?
I
Because
was
you
just
go
about to
into
bring that up. Yeah.
yeah,
That's in addition to this.
yes, and now that we have not only the most valued market ever, we have the most concentrated market ever. Top six stocks are 40, I mean, excuse me, are $20 trillion of market valuations, and they disproportionately obviously benefit from ETF buys. People think that they put money into the S&P every month, that they're diversified. They're really not diversified. Top 10 holdings almost 40% on the S&P. On NASDAQ 100, the top 10 holdings are 52%. No one's diversified. It's amazing. And so when this money comes in, then the ETFs, they have to just allocate based on the, market weighting relative to each other. And so you with buyback shrinking the available floats, you got more and more money chasing ever fewer, lesser available shares, especially when there's low IPO activity. And then on top of all of that, because this is just not enough, the big gorilla in the mist here is obviously the ongoing fiscal dominance that is taking place. Forget all the narratives and tariffs and this and that and the other. The same program I've bemoaned since the last few years with these record budget deficits. Here we go again. $345 billion deficit in August. And that is despite what, 30 billion odd in tariff revenue. So that would even be larger. And net, the deficit's running basically close to 2 trillion. It's higher than even last year. So nothing's changed on that program. And in my mind, the aggregation of all these factors rationally explains why markets keep going one way up, because there's no other way for them to go. The liquidity has to go somewhere.
Right.
Now,
And so, sorry to interrupt, but we're seeing correlation amongst assets get closer to one, right? I mean, everything is up, right? But you would sort of expect that with a rising flood like this, right?
yeah, but I mean, and I have some charts on the different asset classes as well. I mean, you're looking at a lot of asset classes that are getting to the point where you kind of defy, you know, any reasonable type of historic comparison. Uh, even
I think we
even
passed
on
reason a while ago. For one man's opinion, but yeah.
Yeah, I mean, this is the classic Isaac Newton type situation, right? I mean, we all have to assess risk reward for us, and obviously things keep melting up. And when these things happen, as we've seen in the last few years, they keep going up until they don't, until something triggers them. But the net effect is because, and obviously this started before COVID, but it really kicked into full gear after COVID in terms of the intervention aspect. I mean, look at M2 money supply at record highs again, which is $5 trillion higher than it was pre-COVID, when it absolutely went vertical. We're back beyond actually where we were post the COVID printing, and financial conditions are as easy in markets as they were when they ran zero rates and full QE. It ends up disconnecting all assets from ultimately any fundamental reality. And that's always the concern. Now, the Isaac Newton example is, here's a smart guy, probably one of the smartest guys ever. He made money on the way up on the infamous tulip bubble, right? And then,
You made good
you
money.
know,
Yeah.
well, actually, it was the South Sea bubble. Excuse me,
Yeah.
correcting
South Sea
myself.
bubble. Yeah.
It was the
South Sea
South Sea
bubble.
bubble. It doesn't really matter. Bubble, they're all the same. And then he cashed in. He was happy, and then the thing just kept going up and up and up, and all his friends became richer and richer. And then he couldn't take it any longer, and then he decided to chase, right? You get to the point where you know you you are asked by the market in a way to abandon discipline and process, and it's a dangerous time because all of a sudden the old rules no longer apply, right? And suddenly you feel psychologically left behind. You get infected, right, by the overall sentiment. I mean, we've seen this time and time again. Now, for us here is to understand, are these liquidity factors that are clearly dominant in the price discovery equation? I guess the question is, and maybe that's a rhetorical question, but how far can they sustain a historic disconnect from everything? Can it still run into next year or in 2 years? I mean, remember, we've seen this before, even in 99, 2000, where it can defy reason for a long time. Greenspan won in 98. They ignored him for almost 2 years before the bubble ultimately burst.
Right.
But you just have to understand that these factors are supportive of rising asset classes. And I want to bring up one more factor. This is the US dollar on a monthly chart. And I want to highlight something here
Mm.
of interest because the dollar has been crushed this year. It's down almost 11%. Actually, I think it may be down 11% today as we're recording this here. By the way, the day before the Fed meeting.
Yep.
Interesting time. And if you look at the S&P, for example, which rallies and rallies and rallies, is actually up around 12% this year, which on the surface is actually not all that dramatic. I mean, it now feels so dramatic because of the April low that we've had and the one-way rally ever since, basically. But I want everyone to be clear on this. A lot what's happening here is currency destruction. While the S&P is up 12%, the dollar is down 11%. So you can argue on a net dollar adjusted basis, we're actually only up 1% in the year,
Mhm.
which is a lot less impressive sounding. Now, if you're in America, obviously, don't really matter to you. You're up. If you travel elsewhere, then maybe your purchasing power is not as great. But I want to highlight this because this is exactly what we saw in 2017. This was Trump's first term, and there was also tariffs and this and that and the other. And the dollar just dropped nonstop. And that's what we're seeing now. In fact, there was a kind of a bounce here into kind of September or summer timeframe, if you will, and then it dropped lower into the end of the year. There was not, and this is to your question about, thinking about year end, there was not a proper correction in the market until January 2018. It was when the dollar pivoted, that's when we had a quick 10% correction. And of course, 2018 was a much more difficult year. It was actually a down year. And the rising dollar was a big contributor in that. So it's kind of interesting here because we hit a low in the dollar in the spring, and then it bounced off of this key trend line. And we're kind of on the cusp here again at a little slightly higher level, but basically, is it a double bottom? Is it a retest or what have you? In order, in my mind, for the equity rally to really sustain into year end without any hiccup, it needs to continue to see a lower dollar. Okay.
Which means we'd
But
have to punch through that trend line that's been in place for 14 years.
yeah, since 2011, and then we had it here in 2021, and it showed a technical reaction here, so it's pretty clean. And what's also interesting here is this, because this is mentally defying, even to me, because I could argue, well, maybe this is a giant bull flag. Probably everybody's going to laugh at me, um, and it may just invalidate for all I know, but it's actually pretty clean. So what happens here is kind of key, because if the dollar really drops below, then yeah, this this whole asset melt up can clearly continue, if you will. But if you do get a surprise for whatever reason, and this dollar currently is contained by the monthly 5 EMA. Notice I keep mentioning the 5 EMA on different charts and different time frames. It always matters. It's very important. With resistance here on the bounce again. If that were to drop up, then there's your case for a larger market correction because those things have been very much correlated since the April lows in particular. Okay, so something important to watch in terms of year-end pivot of control, and we'll see what happens with the Fed tomorrow, right? Because there's a lot of expectation, obviously, of at least a 25 basis point rate cut. How much of that is priced in to be determined and also dependent on their outlook. But I just find it interesting that we're basically seeing the same behavior as in 2017. And this is where it gets interesting because we all have obviously in our heads ingrained that there's typically some sort of volatility in the September, October timeframe. Guess
Mhm.
what the 1 year exception was? It was 2017 because the dollar kept dropping. And if you look at 2017 from September 1st onwards, nothing but up. There were there were a couple of quick tiny dips into like the
Yep.
30 EMA or the 14 EMA, and it just kept melting up. Now,
Sounds familiar.
2017, it sounds familiar. It's kind of the program that's been running since the summer. Um, but of course, the one big difference to 2017 is that markets are at a whole completely different valuation and concentration equation than we had then. But it is maybe the ultimate bear scenario because you see the daily 5 EMA constant support, get a tiny dip and it gets immediately bought, and that was it for the rest of the year. And then, as I said, there was a big 10% correction in January of 2018. But in my mind, for that to happen, you really need to see a continued dollar crush. In fact, where I find myself at now, at this precise moment in time, and this is just looking at the S&P big picture monthly chart. I'm very curious to see where the month of September closes out. The reason I say that is obviously, as ridiculous as 2021 was, the monthly MACD extension, just an absolutely uncharted history,
Yeah.
massive divergence on that, and we're pressing against this right now as we're recording into a major trend line resistance on a negative divergence, which in the past have shown to matter, right? I mean, you can look at this back in time. Does it matter now? I don't know, but I will know that one of the liquidity legs, not only is RRP all of a sudden not there, but buybacks are also coming out towards the end of the month as we approach the next earnings season. So
Yeah.
I at least want to be mentally prepared for some sort of hiccup if all of a sudden some of the liquidity pulls out, and I'm curious to see how relevant this trend line of resistance can still maintain. If it is relevant, things could get obviously ugly. Notice how they cleanly saved here that dip below
Hmm.
from the COVID uptrend here in April. Now, this is pretty, I think, reflective of how much you have to close your eyes with regards to history of where we are. And then speaking of other asset classes, here's gold. I know it's one of your favorites. Um, Monthly chart, 88 RSI. History for that, very little. I mean, got close to it here, and then we have to go back all the way to 1979, 1980.
Wow.
Okay. And it's like with any charts, it's not bearish until something happens. It shows you how incredibly powerful the price action has been. And, one could argue is, well, gold is acting like we're about ready to hit a major crisis and they need to print through kingdom come. So it is a bit conflating in that sense because obviously the market itself is not taking that message, but obviously we do have geopolitical issues with tariffs, and so we see a lot of central bank buying, we see government buying, and all that. But I'm just saying historically, there really is not any history of sustainability. In fact, when you get to high levels like that on a monthly RSI, you typically do see at least a pullback or something sizable, right? Um, so do I want to chase gold here? No, I don't. Does it mean it's not going to go higher? No, but I do also note a long-term trend line here. We'll have to see if that has any relevance or not. But that's kind of the challenge, I think, in general to say, well, where do I find anything that's attractive to buy, right? Especially if everything's melting up.
Right.
And I mentioned obviously the incredible valuation concentration in just the top six stocks. I
Oh my
don't even
God.
mention the top 10, but $20 trillion in six stocks. I posted a chart yesterday on Google on a daily chart. I'm just using that chart, that stock as an example, not for any other particular reason, but the daily RSI is 887. Um, you know, I don't know how much more optimism you can get, but this is a monthly version of this. And it's not anywhere near its monthly Bollinger Bands. Do we have a lot of history of the stock pushing against the upper monthly Bollinger Band? Yeah. Doing big bull rallies? Yes. Is that a good time to push or buy long? No. In fact, you see often these reversal candles out of a big monthly Bollinger Band extension. But this is a $3 trillion market cap stock now. And there's no precedence for this other than maybe to point it out towards 2007, when we had also a lot of speculation in the market. And that's kind of, another one of those warning signs that hasn't really mattered so far. But, we saw what would happen with Oracle the other day. $350 billion in new market cap based on a PowerPoint deck on one slide. We're going to make so much money in 5 years. Okay, here's $350 billion. So stock goes from 650 billion to nearly a trillion in 30 minutes. That just smells bad, I have to say, from a sentiment type of perspective.
Right.
And so I look at this and go, no, not interested. I mean, if it works out for you, great. I'm just not interested in chasing. It's just part of the whole landscape of is liquidity just total overwhelming everything. And of course, I'm talking about passive investing. We do have the retail mania back in a major way, right? We got what, over $1 trillion in margin debt now. We got people going leverage in double, triple, quadruple. Heck, in crypto, you can get 50 times leverage now on pressing your luck. And then of course we have the systemic issue of ODTE, right? I mean, I'm actually feel kind of bad for Las Vegas because who wants to go to a casino where you can lose money? You know, the, it's I mean, wow. I mean, this as the technician in me, and then now I look at this. Just hate to bring this in because everybody's eyes glazes over, but I want to highlight this. I mean, obviously, market cap to GDP now at 215%. Yeah, let's cut rates. That seems like a good idea because we don't have enough speculative fraud in the market. And I know people will say, well, with these big cap tech stocks, a higher valuation is deserved, but we have just absolutely no history for it at the time when the earnings yield in the S&P has dropped to levels that we've not seen during the tech bubble. It, as we're also playing this massive channel here to the upside. I mean, that's just screaming kind of caution altogether. Now, as we saw in 99, 2000, that can doodle around for a while, but this is not normal market functioning. I mean, this is kind of your normal range, if you will. And notice how, as coming out of COVID, how this was already fairly low and it got punished, right? Now we're even lower, right? And here's a basic fundamental. I know why even bother talk about fundamentals, but GAAP PE is now 30.5. It's now higher than it was here in the tail end of 24 before we had the correction. This so everybody understands. 30.5. If you look at the bull market over the last 30 years, your typical range in bull markets is between, on the low end, about 15 to a high end of about 25. Okay, that's your range in terms of normal bull market behavior. The only at the other time the GAAP PE really spikes is obviously when earnings come down and the denominator changes. But in bull markets, 30 is massively high, 30.5. So you could drop 20% on the market and you still be at the top range of what a normal bull market would be like. I mean, it's expensive, very expensive. But it hasn't mattered at this point. It hasn't mattered. And now I want to bring you to, if you don't mind, to a aspect of all this that makes this all seem rather dystopian in terms of what we're seeing. Given that what we've just discussed about all these asset prices flying to record highs in many cases with unprecedented or rarely seen extensions, you would think you would have just really bullish sentiment on the side of consumers. We don't. We have absolutely dreadful consumer sentiment. In fact, it's basically commensurate with recessions. Um, and so this is where the dystopian part comes in. How do you explain this? And Adam, you get ready for this. You and I have talked about wealth inequality for a few years. Every time you see this type of stuff happening, these big rallies, it obviously benefits the top 10% because
Right.
they own 90% of the stocks.
Exactly.
And there's some data coming out that, frankly, I find highly disturbing, but it makes sense. And that is, if you look at the breakdown in consumer sentiment, those in the top 10% are very confident.
Very happy. Yeah.
Yeah, because they see their wealth go up a lot. And so they're confident. Makes sense. But if you look at the lower consumer spectrum in terms of income, which I hate to tell you this, is most people, confidence is much, much lower. And so when you look at economic reports like retail sales, they look okay, right? Today came in plus 0.6%. Seems okay. When you then realize that we've now reached a point where basically half of all spending, consumer spending, is driven by the very same top 10% that own 90% of the stocks that are benefiting from the asset class melt up. You are overtly approaching new territory here. Now, on the one hand, I can say, all right, as long as asset prices go up, consumer spending is going to go up. But notice how almost irrelevant the lower end of the spectrum becomes. That's the bottom 60%, less than 20% of spending. And now we're going into this new AI world. And I have no idea how this is going to play out. But the worry is that
But if it means less jobs, yeah, for that bottom 60%, it just gets worse.
they're going to get hammered. And, in past cycles, when you have the unemployment rate rising, and that then impacts, filters into consumer spending, that then filters into earnings, and then you have these big, big corrections, bear markets, that type of thing. I hate to even ask the question, but what if it is different this time in a really wicked, wicked way? And that
Mhm.
is they are able to lay off people and replace them with AI and efficiency. And that actually keeps margins up. That keeps the top 10% happy because the stocks are not really hurting. And then when the recession, so to speak, is over, they're not hiring these jobs back.
Right. Those jobs
So,
don't come back. Yeah.
and as bad as wealth inequality has expanded since the age of permanent intervention, what if we're heading into this just new era of permanent underclass that doesn't have a chance? And notice now with all this, not only record gold prices, metals prices, stock prices, we also have record housing prices with an entire generation priced out.
Right.
And now we're going to ease financial conditions even further. And as President Trump promised, boom in the housing market from record levels. I mean, it's obscene what's actually happening on that front. And so this is worrisome. You really have a system that is by the rich and for the rich and everybody else left behind. Been concerned about this for years, but I just see it keep getting worse from cycle to cycle to cycle.
I,
It's
I, I so
right.
appreciate you bringing up those charts and talking about this, Sven, because you and I do talk about this every time we're on. I talk about it a fair amount with a number of other people. Just to, throw another name out there. Someone else who's very concerned about this is Darius Dale, who basically says if the momentum, if the trajectory doesn't change, he thinks exactly what you just said would unfold. Not just an increased dispossession of the majority, but also the fact that, yeah, it probably will end in better asset prices for the elite few that own all the assets at that point. And I don't know if you've heard me talk about this, Sven, but Peter Atwater, behavioral economist, coined the term the K-shaped economy. And I've said, totally get it, but as the trajectory we're going on, what I don't like about the K-shaped uh, analogy, given the fact that so many people are now uh, not mattering, as you said, the K-shape kind of makes you think, all right, well, half the country's doing good, half the country's doing less good, right? And it's like, no, 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 it's much more lopsided than that and getting worse. So I've put out this concept of a lowercase I-shaped economy where you have a very small number of people with all the advantage, totally removed from everybody else doing just great, and then everybody else is the on that down part of the lowercase I, just being increasingly left behind. So I hope we don't end up, in this sort of dystopian future you think we may get to. But like you, Sven, if we don't have some pretty major fundamental changes, I don't see how we kind of avoid it at this point.
Yeah, I mean it's depressing. I mean it is dystopia because and the worry obviously is, and this is what we're already seeing on social media, the ever aggressive anger and hate and people tearing on each other and division. It's awful. And as long as it stays on social media, I guess fine. But we see some
But
of
it's
that
not.
like
And
it's
last
not.
week
Yeah.
has really proved that. Yeah. And to your point, desperate people act desperately. And so what should
Well,
we
everybody
expect as
wants
they getting
someone to blame. Everybody wants someone to blame, and then they get fed, it's this new business model actually that I don't know if you saw this. There was this chart out there about, this may sound quaint, but apparently fewer and fewer adults are having sex on a weekly basis. I mean, it's dropped off dramatically, and I do worry about how much time everyone is spending on devices every day and social media, and their reality gets warped and they get sucked into certain things. They click on something and all of a sudden the algorithm keeps feeding them that, so your perception of reality is getting warped, and before you know it, you got millions on the street rioting, right? um Certainly not a place we any of us want to be at, because let's face it, post World War II, social stability is an important, critical element of, um, a functioning
of a functioning
economy,
society? No, absolutely.
functioning society. Absolutely. And so I think, I see some people stirring stuff up, and I'm thinking, dude, you're playing with fire. Tone it down a little bit.
Yeah. Let me ask you this, and we could tangent on this for another 3 hours, but I'm going to ask you a fairly hard question, which is, I don't think anybody watching this disagrees with anything you just said, Sven. Like, I think we are at the point culturally where we can all look at each other in the eye and agree that social media, digital media is having a toxic impact on society, net, right? Um, but in the West, we have this sort of, libertarian mindset of, but everybody should be allowed to do what they want to do, right? Do you think part of the solution coming out of here is at some point we are going to have to intentionally place restrictions on social media uh, to to reduce its corrosive effect on society? And I don't know the answer to this question, but if we just keep just letting, admitting we have a problem but doing nothing about it, the problem is not going to get resolved.
Yeah, I mean, it is a fairly loaded question. I would agree with that. Um, I can only speak for myself in this regard. I mean, obviously, I come from a time where there was no phones and no social media, so I remember that
We
time.
remember the world. Yeah, exactly.
Yeah, I feel really worried about this younger generation that grew up on all this stuff. This is why I'm talking about, warped perception, warped reality. I mean, you mentioned the event last week. Everybody is eager to find the cause on this side of the political spectrum or this side of the political spectrum. Maybe the more relevant question is, what in society is causing young males to not only throw away their future, but basically burn it up for some act of anger that they think they've been triggered by something. And it's not only this event. I see it even here in the UK. I mean, there's been horrific incidences of teenagers stabbing adults or other teenagers, and it's like this did not happen when I grew up. Um, but it happens more frequently than I'd like to see for sure. And so this is a big societal problem. And then obviously the tech companies take zero responsibility for that. In fact, I hate to say it, going back to the earlier discussion about hate and division, it is the model. I mean, if I maybe this is the lowest appeal to human nature, but if there's a train wreck, people will click on it and stare at it.
Outrage is their business model. Yeah.
Yes, pink fluffy unicorns don't get as many views. And so they have actually a vested business interest in keeping everybody at each other's throats. And we're all being manipulated on that front. Now, the ideal situation is, and at least for myself, is to say, I want to take personal responsibility on this front and say, I'm going to very much limit my exposure to this. I actually happen to believe in my heart that 99% plus of people are perfectly peaceful. They want to live their lives and take care of their families. But there is obviously in every society, there is this element that's not peaceful, and they're causing trouble in various degrees. And social media in particular keeps pointing that out to you. And before you know it, you actually have the perception that everything is horrible. I give you a specific example. Okay, I've seen a lot of tweets this year about how horrible London is and the riots and stabbings and this and that and the other. I've been actually to London a bunch of times. I don't live very far from London, so I'm there on a regular basis. And London is a very diverse city, no question about it. But everywhere I go, and I've been in all kinds of sections of London this year, I've never, ever felt threatened, nor have I seen any trouble, nor have I seen any crime or anything like this. It's actually peaceful. Now, I'm not naive enough to say, well, there's no crime in London. It's a major metropolitan city. Of course, there's crime. There's always crime. But I think what social media tends to do in particular, and the old news media used to do that as well, but I think it's more aggressive now on social media. It's like, oh, look at this guy, look at this guy, look at this guy. And all of a sudden, even Elon goes on this and he keeps pointing out these narratives of reality that I just don't see. And I'm actually there as opposed to Elon. I'm just saying, what are you guys doing? You warping the minds of everyone and thinking things are a certain way when they are not. And so I can't even look at this stuff anymore because, frankly, in so many cases, it's just absolutely mind-numbing, and I don't want to spend my life looking at mind-numbing stuff. So I've pulled back quite a bit on social media, and the young one we have in the house, he's trying to actually wean himself off as well. So I think we do have a choice to make. Now, a lot of people are completely addicted to this stuff, and they probably can't make that choice for themselves. I hate the notion of the government dictating what I can look at and what I can't look at. So don't get me started on that in terms of I don't like that. Okay, but I think it's up to us to take control in how we approach all this. And you know what? We have a choice to say, no, I'm not partaking in this nonsense. I'm not partaking in this, circle jerk of hate and division. But I know it's hard, and it's very hard. Maybe I can start a movement. Join me, Adam. We
Hey,
start a movement together.
I'm ready to sign up, as I think probably 98% of the folks watching this. There is, I think, sort of a bit of a cultural, I think the pendulum is starting to swing, and I've definitely heard this mantra of, hey, go touch grass, right? Like just put the device down, get outside, be in the real world, right? And I hope culturally we embrace that more. And look, this is a huge topic, so I'll get off it in just a second. But I do worry in the sense that, look, you and I are going to be okay, Sven, because we're inoculated from the worst of this because we lived in an era before digital devices, and we can we know how to deal without them and find joy in the world. A lot harder for our kids, right? But they can even find their way with good modeling and good support, right? But not every home has a Sven Henrich as a father, right? And so there are going to be a lot of kids that have just grown up in this toxic soup, and they don't have the resources to help guide them out of it. And that's generally where the worst of this happens, anyways, right? It's the people that feel disaffected, and they go down some rabbit hole that ends up in rage, and then they end up doing something, with that rage that's very regrettable. I don't know what the answer is. I agree with you. I'm very anti-censorship. But I do feel like if we just let it fester, I'm not sure the patient gets better on their own here. But anyways, more for a different time.
Yeah, it's unfortunately beyond our scope, but just I can just share what I'm thinking, and I know I want to keep taking a step back from all that,
Yeah,
take
well, I
control.
appreciate that. And again, at the bottom of all this is what we were talking about earlier through your charts here, which is that we are on a trajectory where a greater and greater percentage of society is going to increasingly feel left behind, increasingly feel understandably angry about that, especially as the top 10% continues just to say, well, why doesn't everybody just eat cake, right? Cake's delicious.
Yeah,
And
exactly.
very little good comes from that in the long run, as history is replete with examples for us.
But as long as nothing matters, nothing matters. And this is the challenge now, obviously, from a market perspective. Now, I want to point out a few things I've seen where I say, okay, they haven't mattered, but they nevertheless point to something ruminating, possibly, that has me cautious. Despite the 2017 example and the dollar coming down, I want to just highlight those. And, those things don't matter until maybe in hindsight and you look at them going, well, that was obvious. We'll see, but I'll point a couple out. First of all, I highlight obviously this massive liquidity correlation on assets prices, and one of the classic I've been tracking for years is Bitcoin and the S&P, and I've called it the same trade, and that is in terms of directional moves. When liquidity in the green is positive, they all rise, and when liquidity gets pulled out, they all drop. And that's kind of been the run here too in the last 2 years or so since the October 22 bottom. More than 2 years now. Time flies.
Mhm.
Um, but if you dig in a little closer, um, I do note once in a while something happens, and that's to me of interest. As you may have noticed by at the moment, at least for now, Bitcoin has not made a new high here recently, despite the S&P making a new high. We've seen that in the last few years a couple of times. One was here in the end of 24, beginning of 25.
Yeah.
S&P made a new high. Bitcoin did not quite a new high correction. We had that here at the tail end of 21. S&P made a new high, famously January 22. Bitcoin did not. It's a potential sign out there that say maybe something is afoot. As I mentioned, there may be one or two legs of the liquidity equation that may be missing for a few weeks. I don't know if that has an impact, but for now, I just note that as a potential divergence, probably worth watching. Then this never-ending rally. This is the S&P components above the 50 MA. Kept screaming back from the April lows, and then it made a new high here in the June time frame. But every new high since then on the S&P has seen fewer and fewer components above the 50 MA. In fact, we got close to 666 this week, and maybe we'll still hit it. I don't know. I'm just using that as a historical reference because of the infamous March 2009 666 low.
Yep.
But as we make these new highs, we see ever fewer components above the 50 MA. I mean, to be here at this level after this continued rally and only be barely see 50%, 56% of components above the 50 MA, that points to some sort of weakening. And incidentally, we've seen this before, right? If you go back here to 24, we kept making new highs, but the components, the participation weakened. It points to a weakening internally in the market. New highs, nicey new highs, new lows, got pushed pretty aggressively here in September. Um, and typically, when it gets that high, it sets up for some sort of dip at least. Seen that plenty of time. How extensive that dip is, obviously, depending on the circumstances. What's interesting is we just kept ripping up, but this indicator already turned, not confirming these highs here. So, it doesn't mean anything. It doesn't mean anything yet, but it's certainly another divergence to worth pointing to. I mean, we had this even here.
Yep.
And, again, this can be minor, it can mean nothing, but I find it interesting that this is a fairly aggressive spike and it goes in the face of a rollover in new highs, new lows. Pointed that out on Twitter yesterday as well. I mean, I've seen many stupid rallies before, but this one really takes the cake on one level, and that is open gaps. 12 open gaps since the April lows. Now, I prefaced the tweet by saying, used an Art Cashin quote, all gaps fill if ever, meaning that some gaps never fill and some take forever. But to me, this is just a basic expression of market imbalance because that's not usual market functioning. Yes, been plenty of rallies where we've seen a bunch of open gaps, and usually most of them get filled, or at least some of them. To have an extended run like that with no gap filling is unusual market functioning, in my book. And ultimately, I think markets like balance, and so to me, that's an obvious risk that at some point we may see some sort of gap filling. How many gaps I can't tell you, but it's just kind of another part of this new silly phase, if you will. And notice we actually have a very clean trend here that actually got saved again here in August. As long as the trend stays intact, bulls stay in control. If the trend breaks, then obviously things can change quickly. This is one of the wildest charts out there. I think it's cumulative new highs, new lows. Uh, Absolutely baffling. This was the 2018 high. This was the 2019 high going into the COVID crash. 2020 high was a slight divergence, and then of course we had the dump, and then the printing that lifted everything up. And then this tightening cycle, we haven't even approached the lows of COVID on that indicator. And as we're making new highs again here in September, we're actually having a lower reading again vis-a-vis February of 25. You know, that surprises me, especially considering how well small caps have done in the summer. You would think we would see a broadening on this. This is one of those charts that just has me going, I know we're concentrated. I know we're dependent on these high cap tech stocks, but that's just another one of those charts that speaks to divergent market behavior. And I got another one on that, equal weight on some measures is making new highs, but I look at the XVG, which is the value line geometric index, and ever since that blow off top here in 21, 22, notice that divergence. We made a slight new high on the S&P, lower high on XVG was a signal then. And, we've never even approached it. I mean, we got close, I suppose, in late 24. Then another divergence, right? We made the February highs, lower high on XVG and down.
Yep.
And this was a kind of a fake throwover, but it created a new trend line. We're not at the trend line yet. Maybe we'll still squeeze higher, but I notice again very tightening, wedging, and divergence vis-a-vis the new S&P highs. So to me, in terms of broad market signaling, it again tells me this is not very impressive. We're just so dependent on the Googles of the world going through the moon. Um, i- i- we haven't really made much progress here vis-a-vis 2018, actually. It's stunning. So the bull market may not be as broad as we think. So what I'm saying, and I have no idea if any of this is even feasible, but based on all these divergences, if something matters in the dollar rallies, one could make maybe the most obvious case. The most obvious technical case would be a retest of the February highs, right? I mean, I can draw all kinds of scenarios, so it's completely speculative. But in this environment, I mean, anyone calling for a 3% pullback is viewed as a raving lunatic, and this would be kind of a 7-8% pullback. That would get us quickly oversold, would fill some gaps. It's one of those scenarios. If the year-end rally history continues, I would love to see something like this just to get a cleansing of the excess, and obviously that would involve some sort of trend break. But I'm pointing this also out in context of the VIX, which has been nothing but crushed since the April lows, and it's
Mhm.
also kind of been tightening. And by the way, I'm not saying we can't make even further highs. I'm not saying this at all. I'm just saying that in context of everything that we've seen, something like this wouldn't surprise me, right? And you can argue the VIX could break out of its wedge and maybe even tag this trend line, fill a gap. There's a gap at 26, and maybe that's it. And then you have your classic year-end rally. Um, I'm reduced to being just highlighting a speculative case because at this point we have zero evidence of anything changing in the program, and the program is higher every week, new highs every week, right? But if something like this were to happen, it also wouldn't surprise me and would make technical sense. But 7-8% pullback, is that the end of the world? No. Not at all. In fact, going back to my quarterly chart, here's the quarterly 5 EMA at 6022. If we were to drop lower, than the MA would drop, and guess all what we would have. All we would have is a 200 MA tag. Perfect support. I mean, it wouldn't even fill any of these gaps. But basically, my view in general is this is if we do see the dollar rallying, if there is some corrective activity, and I know this is a pathetically wide risk range, but I want to stay open-minded. I mean, if it's a 2017 case, maybe a 50 MA is all you get, and that's it, right? But notice the confluence here on the 100 MA and the February highs. That may be it, right? If you do get a pullback, or you have the 150 NA, 200 MA, and a quarterly 5 EMA, and that may be support. And guess what? Any of these would not mean the end of the bull market at all. Okay, you would need to drop below the quarterly 5 EMA and stay below for something to show that actually the program has changed in a major way. At this point, we can't even get a 1% pullback. So it'll be interesting to see what happens tomorrow with the Fed. Obviously, there's been a lot of political gesturing, positioning on this as well. The Fed actually is in a very difficult position, and partially they're to blame that for themselves because they, while they seem to run tight for conditions with high rates, they actually have let incredibly loose financial conditions run. And so now they're in this position where they face these stacked inflationary risks. Now, tariffs are not their fault, but tariffs are filtering in through still. And the full effect is still to be felt. I don't know what the effect ultimately will be. The quickest solution to inflation is, by the way it's always been, which is a recession.
Hmm.
And there are some like UBS that actually point out to recession risk, even though the market is completely ignoring that. But we've seen that before too, right? And in fact, I would argue, you know, as a counterpoint to this 2017 case I pointed out, there actually have been plenty of examples where mid-September presents some sort of peak in markets. We've seen that, you know, mid to third week of September, markets have major tops. Like 2007, on the heels of the Fed rate cut, the markets peaked in October of 2007. Just because you got a smooth run like that doesn't mean it stays like that forever. So um, for us right now, risk reward is not there for new longs, but we're waiting for a technical setup basically to argue, okay, we want to test this level, we're going to test this zone and see if that makes sense for us. Um, just keeping in mind that the liquidity drivers will remain with us, although buybacks are coming out and that may provide a short-term hiccup and that may set up for something here. To be determined, I would argue. And I'm going to stop sharing now. There we go. That was kind of
All
my
right. It
general
was
change.
fantastic as always, and I think really sets things up well for the conference. Folks, this was just the appetizer to what Sven will be delivering at the conference. So let me try to put a bow on this, which is if I took good notes, you're basically saying, hey, look, market's going to remain bulletproof until it isn't. There are plenty of um, potential weak signs of weakness in this market, or signs of vulnerability in this market right now. So even though it's grinding higher right now, if I heard you correctly just a few sentences ago, it sounds like you're not putting any real active trades on this. So sort of your advice to the general investor is not a great market to be deploying fresh capital into. You probably want to wait and see for a better entry point. And obviously, if we get that sort of correction that you think could happen between now and the end of the year, especially if it happens quickly, gets rid of the worst of the overvaluations, that might be a good entry point for an end of year rally. I guess I'll pause for a second. Am I capturing your outlook correctly?
Yeah, I mean, look, not interested in new longs right now at all. Uh, and if it goes higher, it goes higher. I'm fine with that. I zero FOMO. And if people want to go wild and reckless, go right ahead, have at it. It's been a great year for us. The rally from the April lows has been fabulous. And you know, to want to chase something in the current backdrop basically tells me, from my perspective, I have to abandon all discipline and process. I'm not a fund manager, so I don't have these obligations that these guys have. So I have more flexibility. A lot of them can't sell. They need to be long. They need to chase. That's why you have the year-end chase in many cases. And so this is just a personal decision we have to make for ourselves. In fact, you know, I can look at all this and say, well, the US is maybe, from my perspective, don't want to touch that right now. But there are other opportunities. There's some chart setups we're looking at in Europe right now. Europe had a fantastic year so far as well. But that's trading perhaps a bit more cleanly on some levels, and Europe is still cheaper, so maybe we'll find some nicer setups there vis-a-vis the US. So we all have that flexibility and ability to make decisions where we think the best next opportunity is. But yeah, I mean, there are precedences. There's no precedence for the valuations we've seen, right? I mean, this market could drop 50% and we would still be richly valued vis-a-vis all of history, right?
Mhm.
And maybe surprisingly, we do get a recession, and all these things actually do matter into next year. But I'm not shorting this. I'm not interested in shorting any of this. We haven't put any shorts on in years. You know, I mean that not interested in fighting this liquidity machine that continues to distort everything. But picking our spots, being tactical in execution, and know when we like risk reward and when we don't. And right now, we just don't.
Okay, very fair. So, quick question. Let's say the data continues to show a slowing economy that maybe, folks start getting legitimately worried about recession. Would you expect that stocks would eventually have to get that memo and repriced by something more than just the garden variety pullback that you're currently thinking could happen in between now and the end of the year?
Looking back at all these cycles, the one thing that really matters is earnings.
Yep.
You need to see earnings actually drop. The market is still pricing in earnings growth for next year.
Mhm. Sorry to interrupt, but so in your answer, do you need to see earnings drop, like actual earnings reports, we missed our estimates, or do you need to see earnings expectations come down?
Need to see GAAP earnings peak and start showing a slowing. That
Okay,
that
so
has
it's
been a
the
key
P&L reflecting
correlation.
it. Yeah. Okay.
Yeah, as long as earnings keep going higher, you will find some bull that wants to, justify multiple expansion, right? You need. That's why I said this is maybe the dystopian part where you may see a slowing in the economy or you may see a slowing in the jobs market, but because they're able to create surprising efficiencies via AI, and that keeps the earnings picture somewhat stable.
Decent. So it can offset reduced consumer spending because they're getting cost savings of the same amount or more. Yeah.
And to the extent that the lower end, the people that are getting impacted by jobs do not matter to the consumer spending because it's now dominated by the top 10%, you may end up with an even more confounding cycle that
Right.
protects
And
the
to
asset
confound it
class.
further, could be if the government wakes up to the fact that we're creating this permanent underclass and it starts implementing some sort of UBI, well, then maybe consumer spending doesn't actually suffer because that money's getting recycled.
I mean, it's kind of sick if you think about it, but I wouldn't put anything past anyone. I mean, the reality is that and people can't forget this. The amount of this year is the third largest deficit in history, only out surpassed by the COVID excess 2020 and 2021. It's massive stimulative.
Right.
So that
And sorry, that's after an administration that was just elected that during the campaign was one of their key selling points was Doge. We're going to shrink the size of government spending.
it's not what this is the thing. It doesn't. I've been saying this for years. It doesn't matter who's in charge of doing the same thing, and the rest is marketing and narratives. Sorry, to burst anyone's bubble. I mean, was it April? Bessent came out and says, after 40 years of Wall Street's time, it's now Main Street's time.
Mhm.
And 4 months later, he's victoring new market record highs, victory lapping them. Come on. Let's get real here. It was Main Street's time for about 4 days, and that was the end of it. No, it's still very much the same program, and this is why I also can't at this point take these tariffs too seriously. Because what 30 billion tariffs income vis-a-vis 345 billion budget deficit. It's a drop in the bucket.
Okay.
It does. I mean, yeah, it is going to impact some companies and it's going to impact some consumers. Guess who's going to impact? Again, the lower end of the spectrum
Right.
and the consumers. They always get hurt the worst. And so, I would love for the natural business cycle to come to fruition. In fact, the fact that we haven't had any decline in housing price has been sick because it got pushed up because of all the mortgage-backed securities and zero rates after COVID again.
Yeah.
And they
I
never let
just, You probably saw the same headlines, but about a week ago, the headlines were sort of floating that the administration might declare a national housing emergency and take some actions. And I'm like, I don't know how to read that other than problem created by too much central planning intervention to be addressed by more central planning intervention.
Well, I mean what is I mean the official demand apparently is for Powell to drop rates to what,
Yeah,
1%?
1%. Yeah,
Yeah, and how has that worked in housing markets in the past? It's
right.
boosted them up even higher. Now you can argue, well, there's a lot of supply that's not on the market because people are not selling because they don't want to move and pay higher mortgages. I get that argument. But fact is the housing market is at the highest ever. It's as unaffordable as ever. And you know, th- the accountability with that again lies with the Fed, who never takes accountability for anything. So as by the way, and as much as I, you know, philosophically agree with beating up on the Fed, um, I also don't like what I see in terms of taking control of it and making their decision by political degree. I think that's
Right. And essentially making it a proxy of the White House, right? If you stack it with a bunch of, yes men, then what is the Fed even what is the Fed cherry? How does it even matter? Because if everyone's just going to implement what the administration wants, it's
I
just
hate to bring this up, but this is, I mentioned all the liquidity and all these other factors, but there's unfortunately also a political component. When there used to be a time when you had divestiture and no conflicts of interest, or at least a minimization of them, and blah blah blah. I mean, now we're in an anything goes phase. The Trump family is completely all in on crypto ventures. I guess they made $4.5 billion so far in crypto gains this year. And what is the one thing you want if you're running crypto ventures? You want liquidity
right.
and you want lower rates, a lot of lower rates. And guess what? That's what's being pushed. It just, it all fits together. There's that,
Right.
the argument, it's all self-serving, right?
Right.
And then if you, and that's why all of a sudden, what else do you want? You want to control the Fed in such a scenario, right?
Yeah. And in
So,
addition to that, you want lower yields, right? And so controlling the Fed helps with that, but also how do you get the longer rates down? Well, if we have more stable coins, they can buy more treasuries and they can pull yields down, right? So I mean, you're right. There's a whole either self-serving, at least in terms of the political goals. So anyways, Sven, look, I could talk with you about this forever. Thank you so much for coming on and doing such a wonderful job here. Next time you come on, I'll make sure we go long enough that we've just solved all the world's problems and then people can just know what to do. But seriously, I can't wait to see your contribution to the conference. Thanks again so much for doing that. A reminder to folks, if you haven't got your ticket yet, go get it now. Go to thoughtfulmoney.com/conference, register there. Again, there'll be replay videos if you can't watch live, and get your ticket now while we're still offering it at our lowest early bird price discount. And if you are a premium subscriber to our Substack, make sure you look for the code that I've emailed you that you can use to get an additional $50 off of that lowest early bird price. Sven, last question, but most important one. For folks that would like to follow you in your work in between now and the conference, where should they go?
northmantrader.com is the website. We have a service there if you want to sign up to, daily thoughts on the latest markets development. We got the daily market brief. Otherwise, you can follow me on the Twitter feed at Northman Trader, where once in a while opine on things here and there.
Okay, great. And Sven, as usual, when I edit this, I'll put those URLs and the handle to your X account up on the screen so folks know where to go. Folks, the links will be in the description below this video as well. Sven, my friend, can't thank you enough. It's always so great to see you. Great job today, and look forward to seeing you. We're in September, so next month at the conference.
Thanks for letting me ramble on there, Adam. But certainly there's a lot of things to consider and keep abreast of. It's
There,
never a
there
dull
is
moment.
There is, but you have a very excellent perspective and expertise, and the fact that you're willing to share it so liberally is a real gift to these viewers. So thanks so much. All right, well, now's the time in the program we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by lead partners John Lodra and Mike Preston. Guys, thanks for joining me. So everybody, we're recording this a day after I recorded it with Sven. You can tell that by the different shirt that I'm wearing. Reason why we wanted to wait to record was so that we would have the results of the FOMC release, which we just got minutes ago. So, boys, we'll get into the results we saw from that in just a second. But first, why don't we get your guys' initial reaction to the conversation with Sven? Any key takeaways you think are notable to continue to talk about? Mike, why don't we start with you?
Thank you, Adam. We've been following Sven at Northman Trader for years, probably more than a decade, and we appreciate his work. Sven put a lot of very useful charts up, and he talked about these very important trend lines across a number of different markets. The first one he talked about was the quarterly chart of the S&P 500. On a quarterly basis, the S&P 500 has been nothing but up since 2009. It's just a huge amount of time, 16 years, and down candles or red candles on that quarterly chart were very, very rare. And the 5-period exponential moving average has been support, and it's going to be that way for as long as it's going to be that way. None of us really know when the turn is going to come. I'm sure the turn is coming, particularly in light of where we are in terms of cycle theory, like fourth turning theory. And if we look at things like valuations that Sven talked about later in the talk, he talked about the fact that valuations were still at 250%, 215% market capitalization divided by GDP, the old Buffett indicator. Anything over 100 to 120% in the old days was overvalued. And here we are stuck at 215%, and nobody cares. Nobody's going to care until it matters. And the central banks have changed the rules so profoundly that we've become used to this new normal. The problem with all of this wealth effect focusing is it's caused the greatest wealth divide we've ever seen. Like Sven said, the top 10% own 80 or 90% of the assets. And it's just not a fair system, but it continues. And so as we continue into the crisis and climax of this fourth turning, it's probably going to be a really important thing. The difficulty about all of that is it's hard to make day-to-day instantaneous investing decisions because this time has been so different for so long, so much longer than ever before. It feels permanent, but it isn't. A couple other things that I thought were very interesting when Sven talked about the weekly chart. He just zoomed in a little bit. The S&P 500 since April had no real red candles, no real down weeks. The ones that happened were very, very brief and snapped right back. And yet again, the 5-period exponential moving average was support again. So he talked a lot about these things and the fact that the support has been there, particularly for the stock market, the S&P 500. And the trend lines that he showed were very widely respected. And so it's been a trend followers market for a long, long time. He also showed that the S&P 500 and the junk bonds, ticker symbol JNK, I think he used, have literally been extremely correlated. The mirror images, one follows the other. It's been an everything moves together type market. And then he also talked about the dollar. The dollar's been really interesting. Just watching here after the Fed meeting, the dollar just made a new low, relatively speaking, and touched 96.42 on the DXY as we speak. And Sven showed a chart, another trend line chart that was a little bit extended down to the 5-period EMA, the 5-period exponential moving average on his chart, which I think was a quarterly chart. I can't remember if it was quarterly. Maybe it was a monthly chart. But he was showing that it was getting a bit overdone here, and maybe we'll get a bounce. And if we do get a bounce, that could be a negative thing for stocks because lower dollar has been supportive of asset prices. So we'll see. The real question is, do we break this recent low or are we entering a support zone? We've thought here at New Harbor for a while that somewhere around 95-ish is likely a support zone. So we'll have to see. And I think I'll just wrap up with a quick talk about gold. He talked about the overboughtness of gold,
Gold at an 88. I think he said it was either I think it was an 88 DSI, which is like a daily sentiment indicator. But the bottom of the line, the bottom line is it's at the top of its trend line. It's been nothing but up. It's had a big move, and if we've learned one thing in our careers, if I've learned one thing, it's that calling a top is really hard. So definitely don't want to call a top in gold. In fact, if I had to guess, I think it's likely going higher, but the room's getting a little bit warmer, I'll tell you that, in terms of sentiment. So we've done some small things with our positions, like our silver position. We just sold a covered call on yesterday to take in a little bit of premium and to put a small hedge on that position. But we expect, even though they're overbought, we expect those markets to continue to be supportive of higher prices. But don't be surprised if you see a quick shakeout in any of these markets, maybe even most importantly, gold and silver, which are getting a little bit stretched, as he talked about. So, with that, I think I'll pause and give you a chance to talk, Adam. But thank you.
All right. So the chart you first mentioned there, Mike, of how it's been a trend followers market, and the S&P for, I mean, just years now has been running right along the top end of the Bollinger Bands. There hasn't been that much cycling between the top and the bottom of the Bollinger Bands. It's just kind of been riding the top. And the fact that there are very little red candles in that, what I believe was a quarterly chart, like you said. And a key takeaway from that is, especially I think in a general market, it's harder for bears to make money consistently because you have to get your timing right. But in a heavily intervened with market like we have now, I think it's that on steroids. So, it's not to say don't be skeptical, don't position yourself in ways for a market correction, especially when valuations get as distorted as they are now. But you just have to be cognizant of the nature of this deformed market, meaning it can stay deformed for much longer than you expect. And I think most people, I think you guys at New Harbor and me, chief among them, can look back at many periods of the last 10 years and say, oh my gosh, the market stayed elevated for much longer than we thought in a lot of these periods where we were really worried. So I just wanted to make folks, it's really easy to see a lot of that stuff and say, oh my gosh, this pig's rolling over. I got a position, short now. I've just seen a lot of people who have had that same response along the way, positioned short, and then just got steamrolled over as this market just kept going the way that it was. So just a word to the wise there. Again, not to not have hedges, and we'll talk a little bit more about that in a second, but just be careful about how aggressively short you might want to get this market. Speaking of the Bollinger Bands, it just blew my mind when he showed how the top tech stocks were not just trading at the top of their Bollinger Bands, they had blown through it. I mean, to extents that we'd never seen before in the data series. I'm remembering the Google chart that he put up there. That's something where you just have to say, well, look, either the old rules of investing still apply or will still apply at some point in time, or we're just in a totally new game with totally new rules. I see you smirking here, Mike. I presume you probably think, hey, at some point the old rules will reapply, but it kind of makes you feel like you're taking crazy pills when you see stochastic movements like that. Would you agree?
For sure. And this has been going on for years, Adam. It's been driving a number of people crazy for years. Active managers at the top of that list. You kind of have to just pick your battle, really. Here at New Harbor, we have an equity allocation that's relatively low compared to industry norms. We're at around 45%, and we have some hedges around that as well. And so that means if we get a huge melt up, we'll probably underperform the S&P. We've got other parts that are doing pretty well, like gold, silver, and mining stocks. But you can't really have it your way. You can't have it every which way. You're gonna have to pick your battles. And so there's a lot of people out there that are in treasury bills and the T-bill and chill trade. That's not so bad either. Guaranteed 4% with no downside risk. So you can't have it all, particularly in a distorted market, and particularly when you're not going to likely be able to get out. So our advice would be to lighten up. Don't have to be in the move for every bit of it. And this applies too to people that are in gold and silver. We're having conversations with them all the time about Well, shoot, my gold and silver has gone up threefold. You know, my mining stocks are way up. What should I do? It's really, really hard to sell on the way up. And we're telling people you have to mentally do it. Just do it. And we're helping people do it that are overexposed at this point because of this big run. Sell a little bit and be happy when it goes higher
Yeah,
because you're just never going to get the top.
and just to clarify, you're not saying get out of the position. You're
No.
just saying sort of trim back to initial weight. If the portfolio, if the asset is appreciated so aggressively that it's now a much greater percentage of your portfolio than it was when you initially bought the position on, capture some of those gains, rebalance. This is just standard wealth management. And I'm glad you're mentioning
Yeah.
this, Mike, because I brought this up a couple of times over the past couple of weeks, both here and on X. And understandably, there are a lot of people who are saying, no, you're crazy. Why would you sell any of this right now? This is it. This is the moment we've been waiting for. This is when true price discovery is coming into the metals, and then the miners are going to go to the stratosphere. And that very well may all be true. But one, it might not be. And therefore, you want to have some diversification just in case your primary thesis turns out to be incorrect. But also, nothing goes straight up in a straight line. And so by deploying some of these hedges that you're mentioning, Mike, not only are you sort of decreasing your risk, but you're increasing your potential that if there is a pullback, you'll be protecting, more of your core position from that. But you'll also have some dry powder to then reinvest at lower prices and then ride the next part of the upcycle here. So I don't get a sense that you're saying at all the bull market in gold is over. I think you're just saying, hey, look, it's moved really far, really fast. Chances of a snapback are probably not to be dismissed. And rather than just ride 100% of the snapback down and then hopefully continue to ride the resumption of the bull market, have some protection in there just for prudence sake. And then you can use that to your advantage if indeed a snapback does happen.
Yeah, absolutely. People that have been in this trade, the gold and silver and miners trade for 10 or 15 or 20 years, have three times or four times or five times, or maybe even 10x in some cases, if they bought gold back in 2000 in the 300s. They've got huge gains. And I'm talking to people all the time about this. What's the point of doing it if you never use it? So if you put let's just say you put 100,000 into gold and silver back 20 years ago, that might be worth 300,000 now. It might be worth more if you were in miners. And so that might be a much bigger portion of your net worth. It might not be, depending upon other variables. But the point is that a number of our clients are well into their retirement years and they're like, well, what do I do with this? It's worked. Unless you're holding it just for that Armageddon event, which is actually kind of a small percentage probability, sell a little bit along the way and use it in your real life. Remodel the bathroom, put the roof on, buy another car, buy a new car, do something. Do something to make it feel real. That's what I think makes sense. And you'll still have a really good position and be happy when it goes higher.
Okay. Look, so not telling people go out and sell your precious metals positions. And personal preference here, folks. So this is not personal finance advice. I think if you're sitting on ounces, you probably don't want to sell those right now. And so as a protection, you might want to take a hedge, maybe in the form of an option versus selling your actual physical metal. Miners might be a little bit of a different story. But again, the right thing to do is obviously highly dependent upon your own personal situation. And so all I'm going to say, advise people is, if you are sitting on some pretty big gains in the miners, although honestly, this really applies to any stock. I mean, let's say you bought NVIDIA 5 years ago and you've got a massive appreciation in that too. Um, if you don't have a clear sense of what you want to do, let it ride, protect it, sell some of it, whatever. Just have a conversation with your financial advisor and say, hey, look, I've got the good fortune now of having some of these gains, given the rest of my financial situation and my goals and my risk tolerance and all that. What might make sense for me here, and then consider the feedback and then make a decision. Don't make doing nothing your default decision just because you didn't investigate the options. All right. Well, John, look, let's come over to you. Anything to add to Mike's comments on the Sven interview before we get to today's Fed news?
No, the only thing I'll just reinforce is we see much of what Sven has called out there. Some of the divergences, we're seeing some stalling in some of our breadth indicators, for example. Nothing in kind of alarm mode quite yet. But for example, he pulled up the same chart that I pulled up in our video last week together, Adam, showing the kind of rollover, the steady decline in the number of the S&P 500
Hmm.
constituents, trading above their 50-day moving average. So we're seeing this kind of narrowing of the market, which generally, if we see that follow through, it starts to put at risk some of this rally. But we'll wait as that data evolves. But that's just something we've been observing, and I'd reinforce. Of course, the news of the day is the Fed meeting, the most important Fed meeting of the history of mankind. They always are the day of the. So we got those results out as you mentioned, and perhaps we can look together, Adam, at the wording changes because it does speak to, I think, a balance of concerns and risks. But please.
Yeah, let's do that. Just last question for you on the Sven thing before we hop off it. So Sven, who's much more of a trader, right? So I just
Mhm.
want to call out his investing approach, very different from your guys's, because he's much more short-term, nimble in and out. You guys are investing for the long term for your clients. But he basically said, yeah, I mean, after giving us his view of the market conditions, he said, I don't see this as a market that I'm excited to put new capital to work in. I'm much more willing to wait to see what happens. And if I'm right that some of these risks that we're seeing play out, I might have the opportunity to buy in at better valuations. What do you guys think of that at New Harbor?
Yes, we do have a different time frame approach, different philosophical approach, but we feel very much the same way. We've had a very satisfactory year for our clients. Barely saw any downside in the April sell-off, and we've been able to capture a very dramatic upswing since then for our clients. We always look forward, not backwards. No victory lapping in our business. But certain things like precious metals certainly have helped. But as Mike said, we're preaching that it's time to kind of not get greedy here. It's really important to remember what this money is for our clients anyways. They're not trying to post up top decile mutual fund returns. They're trying to live their life comfortably and not without a lot of fear and stress. So that's the necessary ingredient in that kind of objective is to basically harvest those gains and protect them when it makes sense to. We're very much in that kind of easing towards that kind of mindset right now for our clients.
Oh, okay, great. All right, yeah. So let's get on to the FOMC release. At the time we're talking, Jerome Powell has not come out to speak yet, or maybe he's about to, but we're not going to have the benefit of hearing his guidance in this discussion here. So we can talk about that second part next week. But basically, Fed seemed to have done what the markets were expecting, cut by 25 basis points, so a single rate cut. Sounds like there was one dissent on the board. Not a huge surprise. Stephen Moran, who is the recent Trump appointee, who is replacing another Fed governor, blanking on her name, but who left recently. This is not Lisa Cook. She still voted this time around. And Moran wanted a 50 basis point cut. But beyond that, I think it was unanimous for 25 basis point rate cut this time around. And as best I understand, and correct me if you know any differently, John, I don't think they touched the pace of QT.
Yeah, I don't think they spoke to that. That may come up in the presser. If I was a reporter in the room, I'd want to ask about that, especially because there's been some interesting dynamics, shall we say, going on in the Treasury market. For example, there's been some charts making the rounds, and I actually shot a video on our channel that'll probably come out later this week on the pretty dramatic increase by the Treasury in performing what are called Treasury buyback operations. A lot of misconceptions out there, and I get into this in that video. It's not QE. This is not the Federal Reserve printing money out of thin air to go buy long-term Treasury bonds. It's the Treasury itself buying back longer-term bonds in what they call liquidity enhancement operations. And it's a pretty dramatic increase over even last year. And the whole period, like 2003 to 2013, they didn't do any of this. So the fact that they're increasing it speaks a lot of what their concerns probably are. But it would be great if they were just buying back long-term debt, essentially paying off debt. But no, they're increasing issuance of short-term debt to do that. So it's just playing games with the maturity of the outstanding debt. And it checks a lot of box. It makes a lot of things make sense when you think about the bullying and the taunting to lower short-term interest rates. Well, yeah, if the Treasury's going out and issuing a lot of short-term debt, you bet they want the the interest rate lower on the short end if they're going to kind of buy back long term and borrow short term. So that all kind of makes sense. But let's go to the Fed statement because there are a couple of wording changes, and we parse every single word that comes out of the Fed, so we might as well look at it in a red line comparison. So this is comparing today's statement with the last Fed meeting statement. And you'll notice right at the bat, they kind of remove any kind of reference to export, noise related to tariffs and things like that. And they really focus on the weakening in the job market. Job gains have slowed. Inflation has moved up and remains somewhat elevated. But here's the key. It says the committee is attentive to their two main objectives: inflation and job market. And they clearly say here that they view the balance of risk has soundly shifted towards the job market and protecting the job market. So that the key, I think the translation to that is, we'll probably let inflation run a little hotter if that's the consequence of trying to stem the slowdown in the jobs market. I find it curious that they still reiterate the 2% inflation target. A lot of people that think that's a pipe dream, that in fact that they'll ultimately, in trying to defend the slowdown in the economy that seems emergent, that they'll end up having to throw in the towel and arbitrarily capitulate to a higher inflation target. That's to be seen. But
Yeah,
you can see,
my opinion, they're just FYI editorialized. Powell will never give that up, in my opinion. He'll keep the 2% target until he's out, and he'll make somebody else reduce or increase it.
I think that's a fair read, Adam, absolutely. But let's look at the projection. This is a dot plot. Hopefully you can see this. This is basically, I think if there was a little bit of a surprise here, is that it came out a little more dovish than even the market was anticipating, because so six each dot here represents a voting member. So basically six. So as you mentioned, it was unanimous except for one dissent that a 25 basis point drop. But if you look here, six members basically feel that we should stand pat for the rest of the year. Like, in other words, no more rate cuts for the rest of the year. But a full nine are calling for a two, quarter point drops. So two more quarter point drops before the end of the year. One member is calling for another five drops, 5 quarter point drops. So it's a pretty outlier there. But the median,
I'm laughing because I'm going to bet that's Moran.
yeah, well, I saw some speculation that it might be Waller, but who knows? But the median expectation is for two more, and we can kind of actually see that in the data here. This is a comparison of the market implied probability. So if we look at the October meeting, just yesterday, there was only about a 74% chance or probability deemed by the market for another drop at the October meeting. Now that's a near certainty, 93%. So odds have shifted dramatically in the market's eyes that they're going to cut. And then if you go to the December meeting, again, there was only a 70% chance that there will have been 2 additional cuts by December as of yesterday. Now it's 92%. So there's been a pretty dramatic increase or interpretation by the market that we're going to get 2 more cuts. And not to say the market is right here; they get this wrong all the time. But that's at least initially what's being read into it. Market reaction, pretty typical for a Fed day. So far, it's been a whipsaw. This is a noisy page here, but this is SPY, S&P 500. Here's the release, shot up. So stocks rallied a bit on the release. Then they kind of pulled back sharply. They rallied again, pulled back. So a lot of noise there. We look at bonds. This is long-term treasuries. We got a spike higher there, meaning yields dropped. And now we're seeing that pullback. So yields are backing up again. Probably the big move of the day here was the dollar. This is a chart of the US dollar. It sold off pretty hard here, took out the recent low, I think back in April, but it's regaining some ground. So and Sven called out the US dollar weakness as a key pillar in this kind of rally of risk assets. We agree. I mean, that's been certainly a fuel, and so far the path of least resistance seems for a weaker dollar. Though we are getting a bit oversold, and it would not be surprising to see the dollar try to find some footing in this area.
Okay. All right. So, let me get to the so what of all this. So for years now, to be honest, we and many of the other people who've come on this channel and I have looked with increasing skepticism at the employment data coming out of the BLS. That's kind of come to a head in recent months, where it's been very publicly called out as being highly unreliable. And interestingly, some saying they think it should be worse, some saying they think it should be better. But it seems to be the jobs data that really shifted here. Powell, for all this year, this is the first rate cut of 2025. All this year, Powell kept saying, yes, the jobs market is cooling, but it's cooling from an overheated place, and we're calling this normalizing, and we don't see anything that worries us. And increasingly during his pressers, the journalists would say, that's kind of different than what I'm hearing from real people out in the real world. And he kept saying, no, we don't really see anything here that worries us. And then all of a sudden at Jackson Hole, oops, this jobs market is now cooling faster than we wanted to, seems to be weaker than we thought. Now they've just said here the balance of risks are now on to the downside for employment, and they expect more rate cuts to come from here, as you just walked us through. So this is so important because, as we've underscored for so long, so goes the unemployment rate, so goes the economy, and we're now at this point where the economy, the economic data is slowing, right? So we are seeing a slowing economy. We are now seeing a more concerning environment for employment, and yet stocks are still partying, right? They're at all-time highs. So, John, just talk for a moment about how long, in your opinion, and I know nobody knows for sure, but how long, in your opinion, can the markets ignore those fundamentals? Slowing economic growth and potentially worsening jobs market from here?
Yeah, in a word, I don't think that long. The problem is we and everybody else are focused on the day-to-day. So it might feel excruciatingly long, but in the context of the kinds of time frames that our clients need to be worried about, not long. Whether it's, a couple months, few months, 6 months, that's rather irrelevant in the context of a broad financial plan. A couple things. Let me just share. You comment about the job markets. Yeah, and here's a look at the unemployment rate and overlaid with the recessions. What you'll see here in the recessions start, and they're usually post-dated after the fact, but they start in the early phase. At the end of recessions is usually when things get the worst in the jobs market. So it's a classic lagging indicator. So when the jobs market gets really, really bad, probably the stock market has already sold off pretty healthily, and the economy's been in a technical and real recession. So point being is, you look at these turn-ups here, they don't take very long to go parabolically higher. So I do think that the stock market is a bit at odds with what seems to be emerging here, and I think that can turn on a dime, right? You look at history, that's been the case.
Yeah, John, I'm gonna steal a chart in a second here to overlay over yours. Just bear with me 1 second here. All right, let's do it here. All right, so it's the same chart, more or less. You can see this?
Yep.
So same chart, unemployment rate and recessions grayed out there, but it also has the Fed's federal fund rate there in red.
Yep.
And just as you've said, John, when the unemployment rate bottoms out and starts increasing again, it tends to then spike up into the next recession, right?
Yep.
Similarly, with the federal funds rate, when the Fed has been on a hiking regime, plateaus and then starts cutting rates, that also is when usually the next recession starts, and then the Fed is sort of panic cutting into that next recession, right? So here we are, 2025, we're kind of seeing both potentially in process here. An unemployment rate that is bottom, that is now picking up steam, and although not in a crisis level yet, and a federal funds rate that plateaued, was reduced for a little bit, but then kept at a high plateau after that, that now the Fed is starting to cut again, signaling more rate cuts to come in the near future. I guess we have to ask ourselves here, what is going to be different this time to avoid repeating the pattern of almost every other similar cycle here in the past 75 years?
Yeah, well, so that's a great point, Adam. If you look at the 2000 and tech bubble collapse and the '08 to '09 collapse there, one thing that people have forgotten is that the Fed, as you can see in these red lines here, in both those cases, dramatically and almost in a panic fashion, lowered interest rates. Yet it did nothing. If you had, and I have a chart that I won't be able to find in time to bring it up here, but if you overlay the S&P 500, that's exactly when the S&P cratered
Those
over
are when the market
50%.
corrections happen.
Yeah.
Exactly. Yeah.
In other words, cutting interest rates, stimulating, if you will, didn't stop the market from collapsing, right? So this simple mantra that we've all been conditioned that, oh, liquidity, easing conditions means stock market goes up. Well, we have a pretty short memory if we've forgotten that that wasn't the case at all in the tech bubble collapse and the housing collapse. And we are, as Sven pointed, we've pointed out, we're in rare valuation territories. I can't help, Adam, but to share another chart here because this is another take at how extremely overvalued we are. And this is a chart that was put together by GQG Partners, and it basically shows the weight of S&P 500 names that are trading at greater than 10%, 10 times price to sales ratio. Here's where we're in the tech bubble. We are way above that. So, yeah, we can debate about whether the, three or five or seven hyperscalers that are going to control AI are fairly valued or not. But I think it's a whole different debate to say that 35% of this S&P 500 should be trading at, greater than 10 times price to sales. That's crazy.
That is mind blowing.
That'll come to earth. Maybe, and just to put it in the proper context, I think David Rosenberg put out a great table. He basically put it like this. If you look at any time the Shiller cyclically adjusted PE ratio exceeded 35, every single time, I think on a 1, 3, 7, 10-year follow-on basis, the market was down in history. I may be missing that up a little bit, but the point being is that, yeah, valuations aren't very useful in the very short term, but when you start to extend the time frame, without fail, in all of history, when you get above that level, and we're well beyond that level right now, you see negative buy and hold returns. So at the very least, if there's one thing Mike and I would love to get across, if folks have adopted a passive buy and hold approach, now's the time to really question that, or at least not be all in on that approach. Scale back. You don't have to
Right.
be 100% invested in anything, and
Right. Lock in some of those gains. You've been lucky. Lock them in.
absolutely, absolutely.
So, all right, we got to wind things down here. Mike, I'll come to you in just a second. But that's a great chart, John, just to show how bananas this period is right now. But also, what's driving a lot of the stock price appreciation is multiple expansion, right? Is the times to sales, is the times to earnings. And when you hear the word multiple expansion, just think, I'm pulling tomorrow's value into today. And just like if you, I don't know, trying to think of a good analogy here, but you ask your boss for a loan, to pay you early for next week's wages. Sure, he pays you today, but at the end of next week, you don't get a paycheck because you already got it last week, right? So when you pull tomorrow's value into today, when you get to tomorrow, there's a value drought, there's a valuation drought because you already pulled it in, right? So, uh, you know, history shows us when you pull too much value into today, just mathematically, stocks have to really underperform in the following sequence just to balance things out, right? And we have had, I just got to remind people, we've had, now we're on track, I think, for 3 back-to-back double-digit years in the stock market. And we had, barn burner years in 2023 and 2024. Who knows how this year will end? But if it continues appreciating from here over the next couple months, then we're going to have a third barn burner year, which we still don't need to have some sort of reversion to the mean valuation wise. So again, valuations are really bad timing indicators, but they do give you a sense of the confidence you can have that at some point what's going to happen, and at some point we're going to have to go through that valuation drought, which is going to pull down today's prices. So Mike, there's a lot of people watching this who I think are understandably really confused just because things are so uncertain. Hey, there's still a party going on. I don't want to be the idiot that sits out the party, especially when, my brother-in-law, who's a moron, seems to be making money hand over fist here. But at the same time, I also don't want to be the greatest fool who jumps in, on the bandwagon right as the wheels come off. So, what kind of conversations are you having right now with your clients and the people that are contacting you from this thoughtful money audience?
Yeah, I guess there's a little bit of FOMO going on, or fear of missing out, and it's likely to get worse if we have a melt up further from here. It's going to get worse. And my advice to those people that are feeling like they have to get in is don't bother. Honestly, don't bother. If that's how you feel, it's not a good reason to make that decision. The T-bill and chill trade, like I mentioned, still pays 4% annually. If you talk to a professional, talk to us, we can help you get into a model that is hedged. We can help you dollar cost average into a model that's hedged if you want to. But don't make decisions based on emotions, particularly fear of missing out. It takes years to learn yourself, to learn your personality from a trading perspective. And the market is rigged against you, against your emotions, because it's nothing but a sea of emotions. And so you'll likely do the wrong thing at the wrong time if that's going to be your guidepost. So talk with us. We're happy to chat with you, review your portfolio, give you some pointers. We're almost certainly going to tell you to reduce risk, get a little bit of gold and silver if you don't already have some, and be patient, because things have been longer than they've ever been this different before, but they're not going to be different forever. And we think we're getting close to a point where that's going to change. You talked about unemployment. The SOM rule triggered, I think, over a year ago. The first time that I can see on a chart that hasn't predicted a recession. So everything is different now, everything, but not permanently. So just if you don't want to deal with your emotions and all those ups and downs, just go to T-bills and wait it out, or talk to us or somebody like us. That's about all I can say.
Okay. Um, so, I would encourage people who, a lot of your clients are older, right? Um, Approaching retirement and retirement. And honestly, those people have had a great gift, right? They've had this massive, multiple bonanza years in the market over the past couple of years, right? And even though they had to go through 2022, it didn't take very long for valuations to get back there and until new all-time highs now, right? So you've had a real gift here heading into your later stage of investing. And what you don't want to do is put your capital at undue risk of the type of correction that you guys are talking about and are saying, hey, it's highly likely and to a certain extent mathematically inevitable. Again, timing is a little bit TBD, but you've been given this great gift. So revisit how your portfolio is positioned. Make sure that you find ways to de-risk it given this correction risk that we're talking about going forward. And, basically lock in the good fortune that you've had, right? And if the market continues to go up from here, great. That's additional gravy for you. But if it doesn't materialize, if we do go through a correction, at some point in the relatively near future, well, then thank goodness you put the de-risking in place, right? So as I think you guys like to say a lot, a lot of your clients don't have time for a do-over. If there's a 20+% market correction, a lot of them don't necessarily have the decade or 2 decades, remaining to get back to even and then have additional growth on that. So, I think I would say, look, be cognizant of the fact that you're hopefully in a better position today than you were 3 years ago because of the great run the market's had. Be smart about it, be prudent about it, lock in the things you're going to need for your retirement. And then, yeah, if the market keeps going up from here, have some exposure to that so you get that gravy. But don't put yourself at undue risk of your luck running out and having these things that seem to be more mathematically likely by the month derail you from a peaceful retirement. Any closing words on that before we wrap up, Mike?
Yeah, just don't mess it up. Don't make the big mistake. We are at levels that we would not be surprised to see this market peak when it actually peaks, stand for more than 10 years. A lot of people don't have that type of patience to sit through that. It will be okay eventually, but it could take decades. And so again, the sky's not falling. Don't have to sell everything, but make a big move towards conservatism. The market literally has to correct. Really, history says this. our debt situation and the world's debt situation says that we can't allow it to correct. So this is the battle that's going on. Central bankers are trying to keep this thing up and going more and more and more. Young people are praying for a crash, or they should be, because they need it to have a chance. And so the cycle goes on. You know, here we are again in the fourth turning cycle. It's going to happen. History says it's going to happen. Protect yourself. There's going to be opportunity for everybody. It's not going to be an overnight thing where you have to jump in, although it's going to feel like people need to jump in because they're so used to the V-shaped recoveries. That's not going to happen this time. So you're going to have to be emotionally even keeled. And if you're not really used to that, particularly when it comes to investing, you're going to need somebody to lean on, a good advisor, as we said earlier. So,
all right. Well said, Mike. And one of the reasons, folks, why I'm underscoring this so much is the data is sadly clear that investors have the highest exposure to stocks in their portfolio than they've ever had, percentage-wise. And the cohort that has the greatest exposure to stocks is the cohort that is right at retirement age, right when they should be de-risking. So hopefully folks take these words of caution to heart. All right, Mike. Well, look, thanks so much. Folks, if you want to get in touch with John and Mike or one of the other financial advisors that Thoughtful Money endorses, just fill out the very short form at thoughtfulmoney.com and you can have a free consultation with them. It doesn't cost you anything, no commitments involved, just a free service they offer to be as helpful as possible to you. Also, don't forget that we have the Thoughtful Money Online Fall Conference coming up in just a month now, Saturday, October 18th. If you can't watch live, don't worry. Everybody's going to get the replay videos for that. You can go buy those tickets right now over at thoughtfulmoney.com/conference. And do go buy them now if you haven't bought already, because we still have the early bird price discount, our lowest, that we're offering for just a little bit longer. And remember, if you're a premium subscriber to our Substack, check your email for the code I've sent you, where you can use to get an additional $50 off of the price of the conference. John and Mike, it's always so wonderful. Folks, please let them know your thanks for that, as well as letting Sven know your thanks by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Boys, look forward to continuing talking with you next week, especially once we know the outcome of whatever guidance Powell is giving probably right now at his presser. But thanks so much, boys.
Thanks again, Adam. We'll see you next week.
thank you, Adam, and we look forward to seeing you next week. Appreciate it.
All right. And everybody else, thanks so much for watching.